What an exciting time it is to be at Orbis Investments. Acquiring or starting a new company or a new segment is the reason some of us get into business or into senior management. It's what fuels us forward. It's what allows us to have the success that we have. And so today we're going to talk a little bit about that. We're going to talk about achieving excellence through various different acquisition strategies or startup strategies. We'll get into that in a second, but I want to start off by just prefacing everything with a little bit about the philosophies at Orbis. So no outside control or no outside ownership. This is a big thing we're going to kind of keep pushing forward today with the presentation. Basically the idea is that we want to kind of push against the conventional strategies, and that's what Orbis is all about, and we want to make sure that anything we do going forward, it embraces that wholeheartedly. Alignment of interests. This is done through the fee-based, performance-based fee structure that Orbis has. And again, this is something we want to make sure that it keeps on getting touched on in any sort of strategic movement. As well as individual accountability, so a value-added approach. Again, very necessary in any sort of movement going forward. And building sustainability. So again, I'm just highlighting these, not going over them too in-depth. This is just something I want you to keep in the back of your mind as my team and I go forward. So my name is Mr. Brandt, and I'm joined today by Deacon, my analyst, and Brian, my analyst as well. And let's begin. So should Orbis enter the Japanese market? That's the key question. Right after that, if we decide yes or no, if we do decide, should we start from scratch? Or should we acquire? We're going to weigh the pros and cons of both. We're going to go very much into depth on both of those. And by the end of this, we'll have a very solid answer for you. But I'm just going to start off with going through what we think we should do. We should acquire a company in Japan. This is going to be explained more through our analysis, and will hopefully convince you at the end of the day that this is the right move for Orbis. So, just to kind of look at a little bit of the company's overview. So, 11 billion British pounds in assets under management, really strong number. And then also, this is for the Global Equity Fund. So this is basically a long-term strategy fund. Basically, the goal is to outperform the global benchmark. So it's, in other words, alpha, for those of you who have finance-minded brains. You want to be able to provide that return in excess of a benchmark, so that it shows the performance of the team. And for this portfolio, as you know, it's a 5-period return. So we want to make sure that this is aligned, these values are aligned with any sort of strategic movement going forward. In the Global Balanced Fund, we want to have lower risk. So if we do offer this in Japan as well, we want to make sure that that value holds true as well. And the holding period, because it's lower risk, we look at about a 3-year holding period on this. So a little bit of a kind of a overarching analysis of just the softer sides of Orbis. We'll go into the more financial side in a second, but we want to touch on some strengths. So worldwide operations, offices all over the world, ranging from London and then hopefully to Japan going forward. A differentiated fee platform. This is something that sets you apart from any sort of other asset management firm. We think that this is something that's critical to maintain going forward, and we think that no matter where you go out in the world, you're going to make sure you want to be differentiated on many different platforms as you've done in the past. A little bit of a weakness. Weaknesses aren't necessarily a bad thing, but they are things that we can't be naive of. We need to make sure that we are always touching on them going forward, and that is to basically address the fact that we don't have experience in a Japanese market, but of course there are many facets we can do to come around this. We just wanted to make sure that this is put forward. Now, an opportunity is the NISA, very equivalent to a tax-free savings account in Japan. So we want to make sure that this we want to bring this up because it is an opportunity, and it does fuel a lot of the growth in our models and a lot of the assumptions in our models based on this return, this account, just because it'll provide an incentive for people to invest money, and that's something that is very, very valuable to Orbis. And obviously, there's 500 plus security management firms in Japan, so there are many takeover targets, and we'll go a little bit more into depth of those in just a moment. Just one thread we want to touch on is that the Japanese market may continue to stagnate. That's something that we don't know what the future holds. We can do analysis all we want, but at the end of the day, it's just opinions at the end of the day. So we want to make sure that we're taking everything with a grain of salt and doing our own due diligence about that. So now, tackle the first question. Should Orbis enter the market? We said yes, and why do we think that? So the Japanese market, again, just to reiterate, the tax-exempting vehicle, that's a great way for people to invest money, and it's a way that helps them help their families as well. Now, there's about 1.5 trillion yen in securities in Japan right now, and that's a very sizable market size, and I think about 415 trillion yen in assets under management. with about 808 million in management fees earned in 2014. So this is, again, a resource or a revenue stream we'd love to be able to tap into. So that's why this just further promotes that we should go into Japan. And the average margins in 2014 were about 30%. So this is really positive news to have going forward, and this is something that, again, further fuels our models, as our analysts and my analysts will go through in just a moment. Something negative that we just want to make sure we touch first, again, just to reiterate that you always want to make sure that there's a devil's advocate to every side of the story, and that is that Japanese retail investment has been stagnating. I know I just mentioned it, but I just want to further reiterate it again. And now to move on to the kind of two-sided question to this, heads or tails. Should we start from scratch, or should we acquire? We've already tackled that we should go into Japan. Now the question is, how do we do that? And I'm going to pass this on to Ekin, my analyst, to go through it a little bit further in depth.
In assessing our options in entering to Japanese market, we looked at 3 key criterions. And after the criterions, we basically looked at whether we should, first of all, should we acquire or should we start up from scratch in operations. And in terms of assessing these options we have, the 2 options we have, we looked at 3 criterions, which are just culture. And this is significant as the Japanese culture of way of doing investment is different than how we do in Europe and North America, as this is exemplified in the regulatory environment in the financial industry. Another key criterion we identified is whether this operation, whether starting from scratch or acquiring, will be value accretive to Orbis as a whole entity. And another criterion we also looked at was time. How fast can we expand, how fast can we start operations, and what are some restrictions we have from the regulatory environment, and how can that be mitigated through acquisitions or through seeking consultancy and such. Now, going forward, in terms of talking about the positives of acquiring a company, we identified that as is required by the regulatory environment, that Orbis would need a significant key employee that would be required from a compliance and risk management perspective that is experienced in the Japanese market. We believe that this could be mitigated through making an acquisition that would be already allow you to have an in-house employee talent. We also looked at the fact that if you making an acquisition would allow you to have access to established infrastructure in terms of having a brokerage and client base, and how you would start operations, and that would also be a boost in terms of time. You can start operations relatively fast. We also looked at, in terms of negatives, we looked at the fact that culture integration of the employees could be diminishing our flexibility in terms of how we operate. However, we advise the board of directors that when we make an acquisition, that you see a third-party consultancy, HR, Japanese market consultancy, so that we can establish Orbis's way, which is freedom, performance space, and flexibility, and make that cohesive in the Japanese culture. Another factor that could be that should be considered in terms of making an acquisition, whether we can retain key employees, which would give access to our client base in the Japanese market, and we believe that this could be accomplished through offering equity-based compensation. And another negative in making an acquisition strategy could be that the business segments that is not aligned with Orbis's services. And however, we see that as an opportunity to divest the assets and make the acquisition more value accretive. Now, benefits of starting a new company: you wouldn't have any internal cultural clashes, and you can start from operations from scratch and just do the things Orbis way, which is freedom, flexibility, and taking a contrarian way as opposed to the market. And this is also proven in our fees, where we just don't have much marketing, but made some purely on reputation, on our performance. However, negative involved in this startup-driven strategy, expansion strategy, is the fact that there is a lot of high regulatory environment, as I mentioned in my criteria, and this is going to basically extend the amount of time you would have to start your operations in Japanese market. Approximately, it would take 1 year to obtain a license. On top of that, you would have to headhunt certain key employees, such as I mentioned, compliance and risk management that is experienced in Japanese market, and you would also need other key employees to establish your client base. And on top of that, in starting from scratch from the company, you would also have to have hefty legal fees, which we believe could be better allocated towards through making an acquisition. So from a qualitative perspective, in terms of our criteria, which is cultural, value accretion, and time horizon, we believe that acquisition-driven strategy into Japanese market is the way to go forward for Orbis. Now I'm going to pass it on to Brian to talk about how this value equation became upon through a quantitative perspective.
So when you look at a financial company or model, you look at two things or three things. You look at present transactions, you look at a discounted cash flow, and you look at comparables or companies that could be similar due to ratios or anything like that. The things that we focused on today was the discounted cash flow and comparables method. We did not have any information on present transactions, so we went forward with these two. If we look at the positives of a DCF is good because it helps you actually understand what are the key drivers of the business, what actually makes the business strive, and what makes Orbis Orbis. So basically, we wanted to understand if we took a company, started from scratch at a percentage of market share from the total Japanese market, what could we grow at, and what would it actually return as a company or as a startup? And then the other question is if we take a company today and buy it and then grow it at a certain percentage year over year for 5 years and apply a terminal growth rate, what would that value actually come after or to create for the Orbis? When we looked at that, we thought those were the positives of the DCF. The negative of DCF was there's too many assumptions in the model. It creates assumptions, it's not market-based. Basically, we don't actually know what multiples are going on in the market today relative to assumptions we make on growth on revenue, growth on expenses, and growth on EBITDA. So going forward, we looked at, on an acquiring basis, we wanted to see what would be the key assumptions when we acquire a company, such as the revenue and the expenses we grew at a CAGR rate. We found that we believed that revenue could grow at a solid 11.5% rate year over year, and we saw that expenses grew at a 3.96% rate year over year. Therefore, we decided to grow those forward for 5 years onward. For our weighted average cost of capital, we found 7.05% to be the correct rate. If you look at the Japanese market today, and even in the past 5 years, they're stagnant. That means their risk-free rate is basically zero. They're in deflation as a whole country. Therefore, we had to accumulate that into creating our WACC. And lastly, the Gordon growth. That's the key. Basically stating a lot of DCF, a lot of the value comes from a Gordon growth model, and that doesn't make sense here because it could actually be negative. If you have deflation in the market, you're going to have a negative Gordon growth or a negative percentage of growth going forward as you're going to decrease your market share. That's why we use the 0% as our base case scenario, and as you see further, we have a sensitivity analysis to back it up. When we look at a DCF, we looked at free cash flow. So we wanted to understand how we created free cash flow, and you did that off the CAGR rate, and then off the CAGR of revenue and off the CAGR of expenses to create our EBIT. Once we created our EBIT, we divided that by our WACC year over year to create our free cash flow for the next 5 years. Once we figured that out, we decided at a terminal growth rate of 0 with the Gordon growth model, we would create a terminal value of $36 million. Therefore, the DCF valuation of actually acquiring a firm was $47 million. Now, if we look at this puts it into further perspective. This is a sensitivity analysis. This shows you that in Japan right now, you can expect a 0%. But if deflation keeps occurring, we can create even further loss in perspective to a negative 3% growth rate and a CAGR of revenue year over year growth dropping to 9.5%. If you see that the value is around $30 million USD for the company purchase price. That we just want to show you that there's a sensitivity in place to understand where our numbers came from and how it plays into what price to pay as a premium for the company or what not to pay. Now, if we look into actually starting a company, well, your operating margin. Well, we saw that a 30% operating margin was going forward in Japan. We thought that would be fair to continue on. What we created from revenue, though, is we took the actual market and we saw that there was $1.5 trillion in securities in the market, and we wanted to hit a certain percentage of that for the first year, but we actually had to wait because we have to do the regulatory licensing, and then we have to wait 2 years for the actual employees. So our actual growth rate, or our actual DCF, doesn't start till 2017, so we're missing 2 years. And if you actually grow that, if you take that and add a 14% WACC, you're actually losing so much value if you miss the first 2 years of evaluation for a starting company. The reason why WACC was 14% is because if you take a cost of equity on a startup, it will be higher, and cost of debt will be relatively lower than cost of equity, but it'll still be high. You have no pre-existing conditions to actually get a proper way of creating debt. And lastly, Gordon growth. We used 0% as well, again, because we thought it was the Japanese market and we thought we could go forward with that. So when we look at that, year-over-year free cash flow, as I stated, 2016 and 2017 wouldn't actually produce anything because we wouldn't actually be in business. And then from 2018 to 2020, we would produce revenue, and our terminal value would be $27 million from that valuation, giving the DCF $35 million. Once again, this is just a sensitivity analysis of what would happen if different rates changed. So now comparables. Comparables are key because the positives are market-based, so that's actually what's happening in the market today. And the negative is there's no key company that's exactly the same as any other company. So that's the problem. Now if we look at our comparables today, Target Securities, the industry average, and the S&P 500. If you look at it on a ratio basis, Target Securities is undervalued relative to the industry average and the S&P 500. The S&P 500 is your benchmark. So basically, if you produce better and if you can buy an accretive company, you will return more for your shareholders in the end of the day. So if we took the 2015 forecast of EBIT and we processed that on the PE going forward, it created a $9 million valuation. But if we took price to cash flow, which made more sense for a financial-driven firm, it would actually create $39 million. Therefore, the value does range tremendously through different ratios, and we believe that the price to cash flow makes more sense in this scenario. So, taking the criteria that Eakin stated, which was culture, value, and time, we believe that buy is the right solution due to all of our analysis qualitatively and quantitatively. That's why we believe that to achieve excellence, we should acquire a Japanese company. Now I hand it over to Mr. Brandt for the implementation. Thank you.
So just to kind of recap, we've gone through all the thorough analysis, and now we're going to say, what do we do now? So we're starting today. We're going to get your approval on this acquisition, and as well to talk to the board of directors so that we can get the further stamp of approval so we can begin the due diligence and go forward. So the next step, Monday morning, we're going to start calling investment banks and start to look at who wants to be on a deal syndicate for this. Who is the one, which banks want to be a part of this transaction? Because again, all the major players in the investment banking industry love international work. That's what they do. That's what they specialize in. So in the next 2 to 4 weeks, the investment banks will go and they'll screen potential takeover targets. Again, given the case, we only had one, and there's over 500 companies that are potential takeover targets, and that's their job. They're going to go and do the due diligence, put in 100 hours a week, and learn which one is the best for us. So in about a month and a half, we'd like them to have that work done, and we'd like to just have some companies to look at, a small prospectus, and decide on which ones we'd like to make a deal for. After that, within 1.5 to 6 months, the investment banks go and do their due diligence, come up with a value. It'll be very similar to ours, but again, there has to be a premium tacked on, and that'll come with further due diligence, and then we'll make that offer. And then within 7 to 8 months, we're going to go and we're going to close that deal. So this is a very broad, high up overview of what would happen, but this is what needs to take forward. The main points are what would happen on Monday morning and what would happen in the next short term to find out exactly which company is the target here. So I want to touch on some risks. So cultural and operational integration is a main risk, mainly because the operational philosophy might not be aligned. Orbis's investment strategies, Orbis's culture can vary drastically from a Japanese asset management firm. And so we need to take that into account. And the best way to mitigate that is to talk to some consulting firms in Japan. You can use the big names like Deloitte or McKinsey. You want to just make sure that whatever you do, you want to get the feet on the ground over there and see what their culture's like so we can try and best put the two together. And now a second risk that we tackled is that the value that we just went through, all the valuations can change if this NISA assumption falls through, so this tax-exempt security vehicle. If it falls through the floor or something like that, that can change things. Now, something that could affect this is, let's say a new government comes in or policies change, very similar to what happened in Canada with their rate change, or their maximum rate, amount changed. So a way to mitigate this is that we believe a good tactic would be to grandfather any pre-existing clients so that we can essentially imitate the effects of that tax-free system. So with that, I'd just like to close it out and thank you very much for listening, senior management, and if we'd like to open up the floor for any questions.
So your core CAGR assumptions of 10.5 and 12.5 is pretty aggressive. Well, what kind of marketing is required to fuel that growth?
Actually, sorry, but CAGR for revenue would have been 12 or 11 or 10.5%. CAGR for expenses would have been 4%. The reason why we think that growth would stimulate was because of the NISA change. We think that traditionally you would only obtain a certain amount of actual benefit of tax-free savings. We feel like they need to stimulate the economy, and this is the way they're going to stimulate the economy. There's no other way. Japan is not doing well currently financially, and we believe that if Japan pushes forward and stimulates the economy, that'll in turn stimulate us. We believe that a 5-year CAGR from 2010, which is out of recession, to now at 10.5% could be easily sustainable going forward.
The implementation seems to be very short-term. Can you talk a little bit more about what, let's say we acquire someone, what is that going forward look like?
Yeah, absolutely. It's a great question. So yeah, we wanted to take kind of a medium to short-term strategy just to get the deal finished. That's kind of the perspective we took it from. So a further strategy would look more along the lines of an HR kind of scenario where we want to look at integrating those firms. We want to look at making sure that cultures on both sides are happy, so there's no pay disparities or anything like that. We just want to make sure that would be the main thing. So that's where the kind of consulting firm would come in, so that we can kind of get a good, solid view on the company that we are acquiring, so that when we do actually shake the hands and close the deal, we're ready to start working with them, so that in the next 2, 3, 4 years, we can start branding out the Orbis name to them, and so that they can start selling Orbis products.
I have a question about your WACC calculations. For the acquisition, you use 47%. For starting a company, 14%. So automatically, that's going to make really your valuation of starting a company look a lot lower. Can you justify, please, that difference?
Sure. Cost of equity on a startup will always be necessarily higher. Beta is going to be higher on the startup relative to the market. Therefore, we decided to add an additional premium. First of all, second of all, liquidity risk premium. It's going to be impossible to sell. You basically stuck in that actual startup if you invest into it. So you're going to have basically, the key is the cost of equity on a company is going to be way less when you're actually acquiring a company that trades on the market relative to a company that's just growing from its roots. It's going to cost you more, and you're going to want more of a return at the end of the day. And that's why. And the cost of debt is impossible to get for a startup. So basically, you can't have any actual benefits from tax rate or tax benefit where you deduct tax. Yeah.
You talked about selling off or divesting of non-core businesses and that you're an acquisition target. So when you think about the culture of Orbis, the way they've grown their business in other countries, would you think about divesting quickly non-core businesses, or would you think about Orbis kind of growing the type of business that they offer because of the acquisition?
That would be time dependent. We would have to assess how those non-core businesses that is not aligned with Orbis is relatively doing in the Japanese market and what their margins are, and see whether that be value accretive to Orbis as an overall entity. And that would be, again, we discuss board of directors, EU senior management, and from that consultation we would either divest the assets and just strictly focus on Orbis's funds, which are global equity funds, and focus on online retail investment. Or if you want to expand into further segments, then we would take that decision with you and then try to expand on that opportunity that's available.
The cost of acquiring a firm you've estimated is approximately $47 million. Do you have any solutions on how we can help raise those funds in a short period of time?
So the actual $47 million would have been the value of the actual firm with the cash flows going forward. So that's necessarily the value of the firm, what we see it as analysts. If you look at multiples, they're at like 36 million, and on top of that, there's no, for example, the company that was given to us, there's very little debt. So therefore, the way we could do this is to finance it with debt, more or less, and lever up. Because risk-free rate is so low, we could actually get a good spread on our debt and basically finance it with debt, more or less, and that would save us a lot of money. As well as you're going to save on your interest expense.